From wherever you are, I want to welcome you. This is going to be a video tutorial going over S11-7 from the Pearson textbook. All right, so let's just jump on into it. I've got this problem for us already set up in Microsoft Excel. So let's read it and see what we need to do. We have Central Yard Equipment who offers warranties on lawnmowers, and it estimates warranty expense will be 1.4% of sales. At the beginning of 2019, the estimated warranty payable account had a credit balance of $2,200, and during the year, Central Yard Equipment had $580,000 of sales and had to pay out $8,750 in warranty payments for repairs. The first requirement here is to do the journal entry to record the warranty expense and the warranty payments. So as always, I'm going to give myself a journal entry template, as requirement number 1 is requiring us to do the journal entries. So just give me a moment to get this set up. As soon as I'm done this, what I'm going to do is summarize the information that we know and that is given in this problem. So we know it estimates warranty expense to be 1.4% of sales. The beginning warranty payable account had a credit balance of $2,200. So looking at this in a T account, I'm going to say WP warranty payable is $2,200. That's at the beginning of the year. Then what happened is they made payments of $8,750 in warranty payments. What we need to do is record the warranty expense in the warranty payment. Okay, well, this is fairly straightforward. The warranty expense is simply 1.4% of sales. And then it gives us what the sales were, $580,000. So 1.4% multiplied by 580 is going to be the estimate of warranty, estimate for the warranty expense. So 0.104 or 0.014, I'm sorry, times 580 is going to be $8,120. This is going to form the estimate of the warranty expense. Now remember, the journal entry for the warranty expense itself is always the same. So we always have the same accounts. Those accounts are warranty expense and warranty, payable. And here the amount is $8,120. I should be dating this journal entry. This journal entry is for December 31st. Okay. Requirement 1 also asks us to record the payment of the warranty. Now, it said here somewhere they had to pay out $8,750 for warranty payments this year. The warranty payment is always really the same. We're going to lower our liability. We're lowering it by $8,750. This is what we paid out, and we paid out with cash, $8,750. What we need to be cognizant of or be aware of here is the method of payment. It said they paid out $8,750 in warranty payments. Sometimes organizations simply just replace inventory, replace the defect product with a product from their storage room. Sometimes they pay in cash. So we need to be aware of whether the credit is going to be to cash or to inventory. Here it says they made warranty payments, so they paid with cash. Sometimes they replaced the defective product with a new product, in which case we would credit inventory. So here we did cash because of the way they settled the warranty claim. Okay, so that's requirement 1. Requirement 2 is, what is the balance of the warranty liability account at the end of 2019? Indicate whether it has a debit or credit balance. Well, I've already kind of started us here, right? I wrote down what the beginning amount was, and then we had these debits and these credits to the warranty payable account. So if I were to update the T account with the journal entries we just did, I would credit warranty payable by $8,120, and I would debit warranty payable by $8,750. After I've done this, I'm going to have a credit balance of, let's see, 8120 plus 2200 subtract 8750. I'm going to have a credit balance of 1570 in the warranty payable account. Okay, so this was S11-7 from the Pearson textbook. Before I conclude, I want to emphasize a few things about why we do this. Now, it's easier to emphasize if we think about multiple years, if a warranty is offered for multiple years. Let's assume there's an organization that made sales in 2017 of, doesn't matter, $1,000. They would, of course, have cost of goods sold on that. And let's just say it was $20. So their gross profit overall was very, very high at $980. If they offered a 4-year warranty, there could be a warranty claim in 2 years from now, in 2019. If that warranty claim, if there was no estimate, no journal entry that looks like this in 2017 on any of the $1,000 in sales, they would recognize a warranty expense. And I spelled that incorrectly. That's my bad. They would recognize a warranty expense in 2019. Now, this does not satisfy the matching principle. So what we want to do is we want to estimate what warranty expense is going to be in 2017 so that we can appropriately match the warranty expense on the income statement with the revenue that it helps support generate in that same period. We don't know what warranty claims are going to be made in 2017, so we estimate it. We estimate warranty expense. This will allow us to match the expense on the income statement in the same period. Then when a warranty claim is made, we lower the warranty payable with a debit, and we lower cash or inventory with a credit, so that in 2019, it is a balance sheet only impact. We're lowering a liability and we're lowering an asset. There is no impact to net income in 2019 in 2 years when this claim is made. Now, I want to emphasize this problem does not use these dates. This was just tacked on at the end to illustrate why we estimate warranty expense. It's so we can match the expense in the same period the revenue was generated. Okay, this was S11-7. I hope that you found this useful. All right, take care.